Good evening, everybody, and welcome back. Tonight, I wanted to highlight one of the technical tools that I think are particularly interesting and useful when establishing directional risks within markets, and that's the MACD indicator. And tonight, I'm going to use it with an example of within the FX markets. But as with all of the indicators that we highlight within this series of webinars, they can be used on any market, on any time frame that you may well be trading. So the MACD basically is a trending indicator, and it's great at highlighting where the directional trends are beginning to materialize and how aggressive those trends are likely to be. Now, the MACD is the moving average convergence divergence indicator, which is a bit of a convoluted way of saying that it measures the gap between two moving averages. Now, when you bring up an MACD indicator on your charting systems, they will be slightly different as a default setting to the ones I use. I think normally the default setting on the majority of charting systems is using a 26 moving average, period moving average, and a 14 period moving average. Well, over the years, I've adjusted those slightly and reduced them just to give slightly quicker signals. And I tend to use the 10 and 20 period exponential moving averages in place of the usual default setting. Now, the reason I do this is because, as I say, it gives us slightly quicker signals, and it highlights when we're starting to change trends slightly faster than perhaps some of the normal default settings would be. So what the MACD does is to measure the gap between the 10 and 20 period exponential moving average. So as prices rise, the shorter term average will follow price action more closely than the longer term. So as the market goes up or even down, then the gap between the two moving averages will increase. And the MACD line measures that gap. So as prices are rising, the MACD will rise, and we can use that to highlight overextended conditions. But I prefer to use it to actually just gauge the extent of the trending condition. Now, as well as the MACD line, which is the gap between the two exponential moving averages, we also smooth that MACD line by using a 9-period moving average. And this gives us a reference point. So if the MACD crosses its moving average, either to the up or to the downside, then that generates a trigger and gives us an idea of how the market is trading, be it consolidating with a particular trend or tracing out an aggressive trend. So an aggressive uptrend is highlighted when the MACD is above its zero line and above the smoothed average. So this basically is when the market is saying this is in the most aggressive trending condition. The gap between the two moving averages is increasing. The shorter term average is above the longer term, i.e. we're above zero on the indicator line. And that's highlighting the risk and continuation of that more aggressive trending condition within an uptrend. The aggressive downtrend signals when the MACD line is below zero and below its smooth moving average. So again, this is where the majority of that aggressive negative trending condition is likely to materialize and bring about a more serious move within that ongoing developing trend. Now, the third type of signal that I use from the MACD is a consolidation within an uptrend. And this is where the MACD is above zero, but the gap between the two moving averages has decreased. So the MACD line has turned down, and we've seen it break below its moving average. So the MACD above zero, but below its moving average, reflects not a downtrend, but a consolidation within the ongoing uptrend. And it's only when we start to see a cross below the zero line that uptrend will develop into a more aggressive downtrend signal. And then the consolidation within the downtrend comes when the MACD is below zero, but above its smooth moving average in the same way. So this is a consolidation, a reaction against the original downtrend and the potential for a more extended move. So we may well want to use that to close short positions, and look for a more extended consolidation signal. So for me, the important aspect with the MACD is that there are only 4 signals that we need to see. It gives us a very quick and easy reference for the trending condition of the market. Okay, so let's look at it on the dollar-yen chart, on a weekly chart, more or less up to date. And we can see that the MACD line below highlights the trending condition of the market. Now, the most important aspect that we look for in terms of changing directional trend is this 0 line, which we've highlighted with a slightly thicker trend line to highlight the turning points of the market. So basically, when that's above 0, we're in an uptrend, more an aggressive uptrend when it's above its moving average. When it's below 0, then we're in a downtrend. And we then use the MACD to reference whether it's an aggressive downtrend or a consolidation within such. So let's look at the signals that we can see within the MACD on the weekly chart for dollar-yen. And highlighted in red here is when the moving average is below 0 and also below its moving average. So we're in a more aggressive downtrending signal. So in other words, this is where the market is most exposed to a more prolonged downside move until we see the MACD break above its moving average. And that's where the consolidation within a downtrend signal is highlighted here in pink that can actually show when that consolidation, more extended recovery is going to develop. And we may well want to stand aside on that sort of setup and not have a position in the market to see whether the MACD breaks above 0 or it breaks back below its moving average to trigger a more aggressive downtrend again. In this example here, having seen this cross back above the its moving average, we then went on to break above the 0 line, and highlighted in green is when we have the more aggressive uptrend signals where the MACD is above 0 and above its moving average. The consolidation signals aren't sell signals in terms of going short of the market because we're still in a positive trend. But when the MACD is below its moving average, as we've highlighted with the light green, that's when consolidations, reactions are possible before the risk turns towards a more aggressive positive trending condition where the MACD is above its moving average and above 0. So let's look at this on a slightly shorter term basis and turn to look at the daily chart of dollar-yen. And we can see that, again, the same types of signals develop when the MACD is above 0 and above its moving average to highlight more aggressive uptrend signals. And this effectively is where we should need to be longer the market, reflecting that aggressive trending condition within the overall structure. When the when the MACD breaks below the moving average, then that's when we can see a pause, a consolidation, where the trending condition is less aggressive, and we may well not want to be active within the market to see what happens. Now, we can see that when we highlight in red the MACD breaking below its 0 line to reflect a bearish trend, we can see that these signals actually, because that longer term weekly trend was still up, were less significant. So we would have lost money on these trades. But as you can see, the MACD quickly snaps back above the 0 line to reflect an ongoing bullish trend. And we would then look for further strength to develop as that aggressive uptrend starts to develop. So the MACD is very useful in giving us a great feel for the trending condition of the market, whether it's an aggressive trend or a consolidation within that ongoing trend. And most recently with dollar-yen, you can see on the daily basis with the MACD above its moving average, but still below 0, we're within a consolidation phase. And we're really waiting for either the MACD to break above 0, which would reflect upside in the dollar-yen, or the MACD to break back below its moving average to reflect deterioration and the risk of more extended downside developing. Now, one word of warning and something that you need to be aware of with the MACD and moving average indicators in general is when we're caught within a sideways trading area. So for instance, here within dollar CAD, we've actually got quite a clear 4-hour sideways trading range. And you can see that the MACD mirrors that example very well in terms of developing its own sideways range as this sideways activity in price is continued. So we need to see a breakout in price alongside the rising MACD and more aggressive trends to reflect further constructive signals. So just be aware that the MACD within a sideways range has its limited uses, and that we need to really sort of build that in to the overall structure. But it's really a trending indicator to highlight those aggressive trends when we can look to take use of those signals. Okay, so just in summary, with the MACD, the pros and cons of using the MACD, it gives us an easy assessment of the trending condition, whether it's an aggressive up or down trend or a consolidation within that trend. And it also, when used alongside other indicators, the slow stochastic, for instance, which we'll take a look at in future weeks, and look at how we can combine the slow stochastics with the MACD, then it strengthens the signal because it highlights from a timing perspective when those more aggressive trending conditions are likely to develop and how we can see that develop. So we'll take a look at that in future weeks. The negatives or slight disadvantage of it is that it's not a timing indicator. We need other indicators to give us earlier signals. Because it's moving average based, it is slightly lagging, and we need to be aware of that when we're actually using the indicator itself. And that lagging factor does mean that if we were to wait just for those MACD signals crossing above it or below its moving average, depending on the trend, then it may well be that price has moved already to see that signal generated. And this is why we would also use momentum-based indicators alongside that type of activity.